Welcome to part 6 of our financial statements video training. In this video, we discuss the balance sheet classification current liabilities, which includes short-term notes payable, accounts payable, accrued expenses, and customer deposits. Please print the PDF handout shown below this video as it will be used throughout the training.
Okay, let's go down to that section now, liabilities and stockholder equity. So we're on the same page, just the lower half. Current liabilities might be called short-term liabilities, liabilities that we have to pay within 1 year. And I think it's okay to mention that the rule is a little more complicated than 1 year. It's 1 year or the operating cycle, whichever is longer. So if you're in a unique industry, like distilling some liquor or something that takes more than a year, then you can have longer than a year. But 99.9% of the companies have operating cycles of a few months. In other words, a retailer would buy the stuff this month and hopefully it'll turn over in 4 months. So they might have 3 operating cycles a year. The year is definitely longer, right? But there are a few exceptions, and I thought I'd throw that in. Maybe we'll edit it out, but we'll put it in for now. Okay, so current liability, short term, due within a year. And the first one that we've listed is notes payable. Now, we don't have a particular order within current liabilities like we have up in current assets. So let me just mention the order up in current assets. It's how fast they're going to turn to cash, right? So under current assets, cash is listed first, always. And then what's next that's going to turn to cash? And it's usually temporary investments and receivables, and then inventory after that. So there's some logic to that order under current assets. Under current liabilities, here's what we find in practice, that any notes that are coming due, even if they're due in 11 months, as long as they're coming due within the 1 year, they're going to appear first. So it seems like the accounting profession has established that we're going to show notes payable first. Not a requirement, but that seems to be the pattern for annual reports that get reviewed. Accounts payable is usually second. Now, accounts payable, usually have to be paid within 30 days or some number of days. It's credit. We bought goods on credit. We owe our suppliers or whatever. And so we're going to have those listed second. And in other payables, so when you see terms like payable, interest payable, payroll taxes payable, income taxes payable, are indications that we have a liability. And then accrued expenses, those would be things that we didn't really get the invoice yet. So let's say our utility bill. Our utility bill for March electricity isn't going to come till sometime in April, because they're not going to read the meter till April 1st or 2nd, and then the bill gets prepared. We're not going to see it for 11, 12 days, and if we have to do the statement before we get that utility bill, we go and estimate, and we call that an accrual. So we accrue by debiting utilities expense and crediting accrued expenses payable, let's say. So most people don't use the word payable after this, but if I were doing it on mine, I would say accrued expenses payable. I left it off of here because that's normally the way you're going to see it, so I didn't want to go too far off reality. Okay, so things that we'd have to estimate, I list like repairs. Let's say on March 30th, a plumber came in and took care of a leak in our sewers that had to be done, and it was $5,000. We don't have the invoice yet. We better list that liability because we don't want to mislead the readers of our financial statements. Right? If a reader looks at this balance sheet and it says March 31st, and we don't include that $5,000 liability to that plumber,